Welcome to the deep dive. Today we're zeroing in on a sector that's not just critical, but really foundational to the entire American economic machine: consumer credit.
It absolutely is. I mean, if you've ever paid off a credit card, bought a car, or applied for a personal loan, this affects you directly.
Right, it's the bedrock of economic mobility.
And our sources today really highlight that because it's used so often, for everything from major purchases to just managing daily expenses, even tiny structural changes in how credit is priced can have these huge downstream impacts.
Exactly. And that raises the core question that led us to this deep dive. Why is something so fundamental, so critical, still largely stuck in the 20th century?
Yeah, why hasn't it been innovated on?
Right. And the sources suggest the answer is actually simple, but pretty profound. Lending is just incredibly hard.
It is. And to do it well, to do it profitably and resiliently, it requires this relentless, decades-long focus. You need a specifically engineered business model.
And that special engineering is exactly what we are here to unpack today.
We're diving into a recent presentation from a major player in this space, Upstart, which is claiming they're operating in what they call a category of one.
A category of one. Okay, that's not just a marketing slogan, right? That sounds like a structural claim about their whole business.
It is. It's a claim about their defensibility. And their whole point is that no competitor can really challenge them on all three necessary fronts. You have to have an amazing proprietary AI, an efficient capital marketplace, and a scalable consumer brand, all at once.
Okay, let's unpack this then. Our mission for this deep dive is to understand how this company is trying to synthesize those three pillars: technology, capital, and brand, into one unified model.
And we're going to tackle these three pillars one by one, pulling specific data and examples from the source material to show you how they all interlock.
So let's start with the big picture. What are the new market realities that are kind of setting the stage for all this?
Well, you can point to three big shifts. First, and maybe the most obvious one, is that banks are losing market share. For decades, consumers kind of felt captive to their primary bank for loans. But now the internet has taught all of us to shop for loans like any other product. If I can go online and find a better rate.
Loyalty is gone. Yeah, and the sources predict credit will be unbundled from traditional banking and even from those super apps that just try to bolt credit on as a feature.
And that's because credit is just too complex to be an afterthought, which leads right into the second reality. AI is a massive commitment. It's not a feature.
Okay.
The material is really explicit here. They describe AI not as something you can just buy off the shelf, but as a decade-long R&D process. It's immensely complicated, especially in the highly regulated world of lending.
That's a fascinating barrier to entry. So it's not just the tech, it's the regulatory environment that stops banks from being able to iterate and catch up.
Precisely. And the final trend is the evolving nature of capital markets. When the macro environment shifts, traditional banks pull back. They get very conservative.
And that creates a vacuum.
Exactly. A vacuum that is increasingly being filled by private credit entering the industry, looking for reliable places to invest.
So consumers want better options, AI is a huge barrier, and capital is shifting. That brings us to their first pillar: technology, the AI foundation model.
Right. And the core of this is the technology's ability to achieve what they claim is 8 times better risk separation than a traditional model like FICO.
Okay, hold on. Let's pause on that phrase, risk separation. What does that actually mean for the listener? Why does it matter if it's 8x better?
It means precision. So a traditional model might lump everyone with a score between, say, 680 and 700 into one risk bucket. And that forces the lender to charge everyone in that bucket the average rate for that group. But with great risk separation, the AI can look at that same bucket and accurately separate the 20% who are actually safe bets from the 20% who are high risks.
I see. So you're not averaging out the risk anymore.
You're not. And this precision gives them incredible pricing power. They can identify the best borrowers and offer them the absolute lowest rates. This creates what they call positive selection.
Okay, this is where it gets interesting. And frankly, a little cutthroat. If this company is systematically cherry-picking the best borrowers, what happens to everyone else?
Well, it creates a vicious feedback loop for their competitors. If all the low-risk customers are pulled out of the market, every other lender is left with an unbalanced applicant pool.
So their average risk goes way up?
It goes way up. It forces their default rates higher, which forces them to raise their prices, which then just compounds the first company's advantage. That real moat.
Wow. So their tech isn't just about efficiency, it's a strategic weapon that actively makes it harder for others to compete.
It is. And the AI is a constant accelerant internally, too.
Mhm.
It improves verification, servicing, all of it. There's a specific metric here that really struck me.
What's that?
The material claims that for every 1% improvement in the AI's accuracy, they see a 13% improvement in conversion.
1 to 13. How does that work? That correlation seems almost too good to be true.
It's all about reducing friction. If the AI is more accurate, it means fewer false positives, fewer manual reviews, less paperwork. Higher accuracy means higher automation, which means the borrower gets an instant decision.
And that smooth, fast experience is what converts people.
Exactly. It all feeds the main goal, a radically better product that delivers the best rates and the best process.
Okay, so technology is the foundation, but like you said, you can't lend without money.
Which brings us to pillar number 2, capital.
Right, because most lenders, they have this crippling limitation. They rely on maybe one bank or a handful of funds.
And that limits them, usually to only the safest borrowers.
Yeah.
But the bigger problem is resilience. When the market tightens, those single capital sources pull back, and the lender is just left high and dry. It's a very inflexible model.
You can't serve a diverse group of consumers if your money only has one risk appetite.
That's why they built what they call a purpose-built, many-to-many capital marketplace. You could think of it like an intelligent auction house for credit.
Okay.
On one side, hundreds of diverse capital providers, banks, asset managers, all with different goals. On the other side, millions of consumers across the whole credit spectrum.
So how does having, 100 different bank partners actually affect my interest rate as a borrower?
It ensures you get the most competitive rate available at that specific moment. The marketplace uses the competition between all those capital sources to optimize the rate offered to you in real time.
That's fascinating. So the core advantages are, 1, it's scalable because they can serve everyone. 2, it's efficient because competition drives the best rate.
And third, and this is critical, it is flexible and resilient.
Mhm.
If one big capital source steps out, there are 99 others ready to step in. It ensures long-term staying power.
So it's really the application of a free market system to consumer credit. That competition helps optimize both the lender's returns and the borrower's outcomes.
Yep. But a great product and resilient capital are necessary, but not sufficient. To get to that category of 1 status, you have to turn customers into advocates, and that's the third pillar, brand.
And the argument they make here is really profound. It's that a great generational brand isn't built on a funny Super Bowl commercial.
No.
It comes from having a fundamentally better product. The product itself has to be the advocacy driver.
And that superior product is built on 2 things, breadth and speed. Let's start with breadth. By offering 4 core credit products today, they're designing the system to serve you throughout your entire financial life.
This is all about lifetime value, or LTV. They don't want you for one loan. They want to serve you as your needs evolve.
Exactly. And every new product strengthens that relationship and critically feeds more data back into the AI models, making them even smarter. They have clear metrics on this. Their current user base shows over 75% have a car, 40% have homes.
So they're just maximizing the value of that relationship.
For sure. Yeah. But the real magic, the thing that gets those 5-star reviews, is the speed and the simplicity. This is where that AI accuracy from Pillar 1 really shows up for the user.
The process itself.
Yeah, it's so simple and personalized and fast that borrowing can genuinely feel effortless. They report that 90% of their personal loans are approved automatically.
With no paperwork.
No paperwork.
That is a game changer. The source material actually says the process was so fast they had to name it the Upstart Fast Track because people were getting confused.
They were. Leaving reviews like, wait, did I just get approved? I was only on the website for 6 minutes. The application was done before the psychological expectation of waiting even kicked in.
And they applied that speed across all their products, right?
All of them.
Hmm.
They claim to offer the only instant auto refinance product on the market. That's a process that usually takes weeks of paperwork.
And even in home lending, which is notoriously slow, their new product is already twice as fast as the industry standard. We're talking about saving people weeks.
The outcome is just clear consumer advocacy. Tens of thousands of 5-star reviews on Trustpilot that have just mentioned the rates. They cite the incredible ease and speed. That advocacy fuels the brand.
And we can see this product-led growth strategy in action with the case study they shared on their auto refinance business.
Yeah, this was really interesting. They initially realized that traditional marketing spending a ton on awareness to drive customers to the auto product just wasn't working. The economics were bad.
So they pivoted.
They made a critical pivot. They shifted their marketing dollars into the product itself, passed those savings on to the consumer, and focused on offering the product to their massive base of existing personal loan users.
Which gave them better economics, higher volumes, and stronger relationships. Let's walk through the timeline of the real customer they mentioned, Fran Graham.
Okay, so Fran comes in one afternoon, say 11:53 a.m. She's looking for a personal loan to pay off some high-interest credit card debt.
About 10 minutes later, she's done. The entire personal loan process. Decision made, funding initiated, that's already incredibly fast.
But here's the genius part. Because they had her profile data, the AI knew she also had a car that could be refinanced at a better rate.
So without her even looking for it, they just offered it to her.
9 minutes later, at 12:05 p.m., she accepted the offer and completed the whole transaction. Two complex financial products originated and closed in less time than it takes to eat lunch.
Wow. And she walks away having saved money on her credit cards and $420 a year on her car payment.
Think about the business impact, too. They originated a second loan at what is effectively 0% customer acquisition cost.
Zero CACs.
And they deepened their relationship with Fran. This blueprint led to almost 20x year-over-year growth in that auto refi product.
So this all brings us back to the synthesis. The category of one claim really depends on the seamless integration of these three pillars working together.
It has to be all three. Proprietary AI that gives you that 8x better risk separation. A flexible capital model with hundreds of partners that ensures resilience. And the product breadth that unlocks that incredibly efficient zero CAC growth.
And their future vision is, well, it's incredibly ambitious. They talk about a world where the best borrowers don't search for credit, they simply have it.
Yeah, this idea that credit is always on. Zero friction, guaranteed at the best rate, priced with absolute precision, making access as simple as using a credit card.
That's a powerful vision, and it raises our final provocative thought for you to consider. In an era where every company is trying to bolt on AI, the real defensibility here isn't a single feature. It's the sheer complexity and integration of these three systems.
Right. It's the massive head start. The deep learning AI, the custom capital marketplace, and a product experience that uses speed as its brand, all built at the same time, all working together.
Can anyone truly catch up when the technology is so deeply woven into the business model, the capital flow, and the consumer experience all at once?
That integrated platform, that category of one, is what is truly attempting to redefine the entire consumer credit industry. And that's a deep dive for you to mull on this week.